All right, good afternoon. I want to thank everybody who's hung in here to watch this presentation live today on investing in real estate without paying taxes. We're going to talk primarily about self-directed IRAs today. And some of you on the call may already be very familiar with self-directed IRAs and what entails, a lot of what the rules are, maybe looking for a refresher. And a lot of you on the call may be not familiar much at all. And this presentation today will hopefully give you the information you need to understand a little bit more about what self-directed IRAs are, how retirement funds can be used to invest in real estate. That's primarily what we deal with here at Advanta IRA. So a lot of our presentations, our webinars, are focused on using retirement funds to invest in real estate. Now, anyone who's watching this or viewing this on a live basis today, if you have any questions at all, please type your questions into the chat boxes on the screen. We'll be happy to answer those as they come up. If you're watching this on a recorded version, please write down your questions. My contact information will appear at the end of today's webinar for you to contact me at that time. Just a little bit of background on myself. My name is Scott Maurer. I'm the Education Marketing Director for Advanta IRA. I am also a licensed attorney. I do not practice law for Advanta clients. I do some things a little bit outside of Advanta. But I've been with the company now since early 2006, and at that time, if anyone will recall, where the real estate market was in general in the country, it was kind of certainly on the way up, not too far from maybe the precipitous decline we saw that followed. But I started with the company back in 2006, helping people through the closing process. Again, for the most part, dealing with real estate transactions, private mortgages, other things we'll talk about. I've transitioned more in the last few years to doing the education and marketing side of the business, giving live presentations, teaching continuing education classes for CPAs, attorneys, and realtors, and certainly doing webinars like the one we're participating in today. Just a quick disclaimer on Advanta IRA services so it's clear what we do and what we don't do is we don't provide any investment advice or endorse any particular products or do any due diligence. We admit we exist as a record keeper to hold alternative assets like rental properties, rehabs, private mortgages within a retirement account, making sure the process is followed correctly as best as possible. We don't make any recommendations as to a particular investment someone's looking at making. So we'll provide kind of some case studies today and go over some information, certainly which is helpful and helpful to the clients. When it comes to individual investments, clients do need to consult with their legal, tax, or investment professionals to get that specific advice on something they're looking at doing. Now, we can certainly refer you to an attorney or a CPA who would be able to help you make that determination and who's familiar with self-directed IRAs as well. Just a quick background on our company. I mentioned I started back in early 2006. The company has actually been around since early 2004. And the only business we have at Advanta is the record keeping and administration for self-directed IRAs or other retirement funds. We can only handle what we consider what's called qualified money, money in an IRA, money in a 401k, things like that. We cannot handle someone's personal savings account or do the record keeping for those types of assets. We do have a local feel, I think even for clients who do not live geographically close to us and to the point where they can sit down and meet with us face-to-face. Even for clients outside of that area, you get appointed an account manager at Advanta. When you open up an account, that person will work with you all the way through the closing process and be your direct liaison, direct contact for anything you need in relation to your self-directed IRA account. Now, one question we do get asked from time to time for someone who's found our company, who's asking some questions about what we do, and it's really, why haven't I heard about this before? You know, somebody who's had an IRA maybe for 10, 15 years and's never heard that they could invest in real estate with their retirement account. And a lot of times people ask, well, why haven't I heard about that? Well, for the most part, I think over 95% of retirement funds in this country are held in more conventional type retirement arrangements where people are investing in stocks, bonds, mutual funds, maybe a CD at a bank, because their accounts are with a custodian who is offering them those limited investment options. Charles Schwab, a Vanguard, a Fidelity, those companies are interested only in promoting those products that they sell and that they will hold within their particular retirement account. They're not going to let their clients know that you could take your IRA funds and invest in real estate, or you could invest in private mortgages, do things like that, because that's not something that they sell. So that's the main reason why I think a lot of people are unfamiliar with this as an investment option. IRS regulations do allow you to invest in the things we're going to talk about today, but they do not require each custodian to hold those types of assets. That's why Schwab has made a decision as a company to only handle those types of private investments. And companies like ourselves, we do not hold publicly traded assets. We typically only hold the real estate, the alternatives that we'll talk about here today. And certainly one of the benefits of self-direction, I think in talking with our clients over the years, talking with other investors, the thing they like most about self-direction is really being able to choose the investment that they know and understand. It's not having your money tied up in an account where you're trading publicly, or where you're investing in publicly traded assets that you're maybe not so sure about, not necessarily comfortable with that investment. They like the fact they can also invest in things that are tangible, as opposed to buying a stock, buying a mutual fund, not something you can necessarily touch. They can look at a piece of real estate. They can see what neighborhood it's in. They can see what kind of surroundings that particular property has, and maybe able to understand a little bit more, or have a better understanding of how that property will earn them or their IRA account some income. They know rental rates in the area. They know there's a strong rental demand, for instance. So a lot of people, again, they like the benefits of self-directed IRAs because it's enabling them to get more diversity within their account by choosing those investments they understand. I think we have two main reasons, maybe a third that I'll tack onto this slide as well, that people choose to self-direct. One, the main reasons we see people self-directing is it's a new source of capital for them in order to make an investment. Whether it's real estate or whether it's a private stock, individuals a lot of times will come across an investment opportunity, the one that they see great potential in, and so they start looking around at what assets, where can I pull the cash from in order to make this investment? Because I know it's a winner, I know it's a good idea, I would like to participate, and they don't realize that IRA fund that they have sitting over on the side actually can be used for this type of private investment. They may not have the personal savings, they may not have a desire to go out and obtain another mortgage, but they can simply use their IRA, the cash in their IRA account, to acquire those assets. So it's not necessarily from a tax perspective they're looking at the transaction, more so just as another avenue, another source of capital for them to make that a particular investment. Another aspect, though, is the tax-deferred, the tax-free investing nature with IRA accounts. If any gains made within an IRA account are generally tax-deferred or possibly tax-free if you have a Roth IRA account. So an individual who's anticipating a lot of great returns on a particular investment may choose to use the IRA as the vehicle so that they are not going to personally pay taxes on that investment. They could be in a high tax bracket right now and not want the extra income that's associated with the investment now. They're willing to make the investment through an IRA and continue to defer the taxes into the future. And again, I see a third reason people are investing their funds into real estate kind of goes back a little bit to that last slide, is that people are just looking for alternatives. Their money has been in the stock market. They've experienced the ups and downs of the stock market, seen their 401ks become 201ks and then back to 401ks again. They're just looking for something that's more stable, something that they understand a little bit more. So individuals are starting to look for other avenues, other places that they can invest their IRA funds, potentially earn either more consistent or at least understand what it is that they are investing in. Now, the types of assets that can be held within an IRA account are really real estate in any form, whether it's a raw piece of raw land, commercial property, or rehab, flips, residential property or commercial, condos, duplexes, single-family homes. Any type of real estate can be held within an IRA account. Now, there are some restrictions on what you can do with the real estate, who can use it, etc., that we'll talk a little bit about later. But as far as the real estate investment itself, there is no restriction on what can be held. We also do we see clients, I should say, make a number of other investments that I call or lump into one category as almost say paper assets, where individuals, rather than buying a piece of dirt or buying an actual single-family home, they might be lending on that property, lending money to a third party and getting back a mortgage that's secured by that particular piece of real estate. So the investment the client holds is not actually the property. It's a piece of paper. It's a note. It's a mortgage in their IRA. And again, notes and mortgages are other types of paper assets as well. The tax liens, you can purchase a tax lien against a particular property. Various types of assignments, option contracts, a lot of really creative things I've seen people do with paper, again, can be held within an IRA, just making sure depending on who's on the other side of that transaction. And again, kind of other alternatives. We've seen a number of people do a lot of other interesting investments, people investing in LLCs, LLCs that are either created simply for that IRA, which they refer to in the industry as a checkbook control IRA. We'll touch on that at the very end of today's webinar. But LLCs also are created to aggregate large number of investors, maybe into one pool of funds. You could have 10 different investors all putting their funds into the same project. Might make more sense to structure that within some type of LLC or private partnership. You can also invest in precious metals, commodities, foreign currency trading, equipment leasing. Even we've seen some clients invest in some farm animals and livestock, as that is permissible investment within the IRA as well. Now, before we go into more of the details on the actual investments, I did want to just cover quickly some of the basics on IRA accounts. Now, the types of accounts that can be self-directed. Any type of IRA, if you have an account with another financial firm, and in that title of that account is a designation of an IRA, whether it's a regular IRA, a rollover IRA, a Roth IRA, a SEP, a simple IRA, those accounts can all be self-directed. It's a matter of simply opening up an account, like account with us, and then requesting a transfer of those assets or that cash from those other accounts into the Advanta IRA account. Now, the traditional and Roth IRAs, those are individual accounts where an individual, as long as they have earned income, can make contributions on an annual basis, which we'll have the limits here on the next slide. The SEPs and the simples, though, those are more for, we call them employer-based IRAs, where if you own your own business, or if you work for a company, maybe a small business that has a SEP or a simple plan, with these accounts you can just, they're treated tax-wise similar to a traditional IRA, but you can contribute quite a bit more money in a given year into those types of accounts. Now, the traditional, the SEP and the simple are all considered tax-deferred accounts, whereby you make contributions into those accounts, you get a tax deduction. Your money is going to grow tax-deferred over the course of your lifetime, so you're not going to pay taxes as you invest and reinvest. But when you do pull money out in retirement, you are taxed at that time. So you get the benefit of at least compounding your money over that time period. Now, the Roth IRA is the one account that's a little bit different. The Roth IRA, you do not get a tax deduction up front, which a lot of people are okay with, because the benefit of a Roth IRA is that ultimately when you receive those funds in retirement, you will have had the benefit of tax-deferred growth over the course of your lifetime just with the traditional IRA account. But the added benefit, the huge benefit that the Roth IRA gives you, is that ultimately those funds come out to you tax-free in your retirement. The IRS deems you have already paid tax on that seed money that you started the account with, and whatever it grows to in the future is ultimately coming back to you tax-free. Now, in addition to the IRAs that we hold, we also offer an individual 401k account, where a sole proprietor, someone who owns their own business, can contribute more money into that solo or individual 401k account. We also offer education, health savings accounts as well. These are obviously not retirement accounts per se, but they do have similar tax benefits that the other accounts that we're talking about above as well. Now, the contribution limits, the slide simply here for 2014, shows the limits for each of the individual accounts here. Again, the key component with every account other than an ESA account is that you do have to have earned income. So you have to have W-2, 1099 income, some type of income you are paying Social Security and FICA taxes on in order to justify your contribution. Now, if you're an individual, you can do the traditional or Roth IRA where you do the $5,500 or $6,500 a year. If you do own your own business, that's where a SEP, a simple, a 401k, all could be three different options that you'd have. Our recommendation is always to go seek the advice of your tax professional, your CPA, etc. Ask them which plan makes the most sense for your business and for you personally in what it is that you are trying to accomplish. They all have different formulas are involved, so some may be more beneficial than others. It's hard to kind of cover those with a blanket statement. Now, to move money, if you have an account with a Schwab, you have an account with a Fidelity, how do you move the funds from where they're currently at over into a self-directed IRA. There's a couple different mechanisms that people use, and it's important to understand how that process works and what the tax implications, if any, there are on the movement of that money. Now, the easiest way to move money from one IRA to another IRA account is via a trustee-to-trustee transfer. This is a non-taxable and non-reportable event where we submit a form. You would fill out a transfer request form on our letterhead. We send that to your current custodian requesting that they send cash, either the whole account balance or any portion thereof. It's not required that you transfer all of your monies. You can transfer just what you need. But you fill out that transfer, you do not touch the funds. So the monies will go directly from your Schwab Roth IRA to your Advanta Roth IRA, for instance. It doesn't touch your hands. It's a non-taxable, non-reportable event. Another common way we see funds moved is when we are involving an employer's plan. Now, a lot of individuals work for private companies. Over a number of years, they build up a sizable 401k, a 403b, 457, some type of pension plan within that employer. And once they leave their employer, or they attain a certain age within the plan, they're able to take money out of that employer's plan and roll it over into an IRA account. They call that a direct rollover because, again, the funds move from the 401k directly into the IRA. It's, again, a non-taxable event to the client to move the funds that way. Now, as far as the employer-sponsored plans, typically it does have to be a former employer's plan. Many times, if you're involved in a current plan, the rules of that plan will not allow you to roll funds out as long as you are currently employed. But you can check with your administrator because sometimes the rules do change. Now, just one important note, there are transfers, moving money between IRAs without you touching it, direct rollovers, which is money from an employer plan to an IRA, and then also, more importantly, the earnings within an IRA account are unlimited. So you can move money back and forth between two different IRAs as often and whatever you'd like, and certainly your IRA, whatever it is invested in, is unlimited as well. So the contribution limits we talked about on the previous page, the previous slide, is really the limit on the amount of money out of your pocket in a given year into a particular account. There is no limitation on earnings or transferring money between accounts. It's very important to remember, if you're looking at buying investment real estate, now if you're buying personal residence, it may be a different story, but for the purpose of what we're talking about today and what we deal with on a regular basis is clients investing in real estate. You don't want to take the money out of your 401k, out of your IRA, to make that investment. And a lot of times people will get the misconception because they talk with their broker of, I want to use my IRA funds to buy the real estate, and the broker says, well, you know that's going to be taxable, and because you're under 59.5, maybe you're subject to a 10% penalty on top of that as well. So individuals either make the decision then not to use those funds at all, or I'm going to go ahead and just pay the penalty and pull the money out. That is not the right way. If you're looking at investing in property, what you would want to do is set up a self-directed IRA account and then transfer funds or do a direct rollover to another IRA. And we've had people who have run into in the past who have been doing, unfortunately, what's on this slide. They pull money out of their 401k personally, then use it to go buy investment property, and they're losing 20 to 30% probably their purchasing power just in taxes. And then obviously going forward, they're going to have more taxes on the gains to that from that investment as well. So it's important to don't take the funds out of your IRA, out of your 401k. Look instead to roll those funds into a self-directed IRA, preserve the purchasing power. There's, again, no taxes on a transfer, no taxes on a rollover, and you're going to have no taxes due on the earnings as they're coming back into the IRA as well. Now, when the IRS created IRAs back in 1975, they wrote just a few rules as far as what you could or could not invest in within an IRA account. You'll find a lot of people will say, where do I go to the code to find that I can invest in real estate? Where does it say I can invest in private notes or stocks or bonds for that matter as well? And there is nowhere it says that explicitly. The IRS, when they created IRAs, simply found it much easier to limit what can be invested in as opposed to trying to think of all the different potential investments that could be made within an IRA account. And again, here's a list of just some of the things we talked about a little bit already on a previous slide. And again, there is no master list that the IRS has for investments. In fact, the IRS said the only two investments you cannot make within an IRA account are collectibles and life insurance. And collectibles would include your antiques, alcohol, artwork, stamps, coins. Now there is an exception of coins if you're buying U.S. silver, U.S. gold, the minted American Eagle coins, bullion, things like that. There are exceptions for that, but I'm talking here more about your rare coins. So the IRS says these are the only two investments that you cannot make within an IRA, life insurance and collectibles. But the one area they also addressed what they would not permit within an IRA is your IRA dealing with or transacting with certain disqualified persons. And this is something that will come up more so when we're talking about real estate investments within an account. Before we go any further, just outline who is a disqualified person for your IRA. Well, a disqualified person for your IRA includes yourself as the IRA owner, your spouse, your parents and grandparents, your children and grandchildren, and also spouses of your children and grandchildren, and then included any business or entity that is owned or controlled by one of the above. These are all, there's a couple other categories as well that are usually not as applicable, but this is who your IRA is prohibited from transacting with. These disqualified persons cannot transact with your IRA. They can also not get a current benefit from your IRA account either. So when we talk about a prohibited transaction, you have your IRA, a disqualified person, and then a transaction between the disqualified person and the IRA. Now that's kind of the most important thing to understand, and it gets nuanced, unfortunately, or fortunately, depending on your point of view. A transaction is what we typically would define when you're looking at a transaction between a disqualified person and IRA. That's a situation where the IRA and the disqualified person are on opposite sides of that deal. If you were looking at having your IRA and a disqualified person on the same side of a deal, for instance, you're buying a piece of property, half of which is being paid from your IRA, the other half is which is coming from your personal savings, that type of an arrangement we consider to be partnering, and partnering with a disqualified person is indeed possible. We'll go over a little bit more detail with a case study, an example about that. But just some examples of what transactions with a disqualified person. Again, if you keep in mind that the IRA and the disqualified person are on opposite sides of each deal here, maybe you'll understand a little bit better about that rule. For instance, your IRA wanting to buy a piece of real estate from your son. Your IRA is a buyer. Your son is a disqualified person. He is a seller. So the IRA and the son buyer-seller relationship, that's going to be a prohibited transaction. Your IRA owns a piece of real estate and leases it or rents it to your daughter. Again, your daughter is a disqualified person. She is the tenant. Your IRA is the owner/landlord of the property. That's going to be prohibited as well. Your IRA lending money to your son, kind of the same example as the first one, just the difference here is your IRA is a lender, your son is the borrower. Your IRA purchases real estate and hires your son or his company to perform the rehab work. Now your IRA is the owner of the property, your son's or his company is the contractor. Again, that's prohibited as well. Your IRA makes a down payment for a property and you personally guarantee a mortgage. IRS rules prohibit you from using your IRA as collateral for a personal loan. So if you were to sign that note on behalf of on the property and it's going to benefit your IRA account, the IRS prohibits that as well. Most of the transactions, if not probably 99% of the transactions we see involving real estate, is a cash deal. The IRA buying a property for cash without any mortgage. If you are looking at financing, it may be possible to do so with a non-recourse loan. We'll talk maybe a little bit about that later. That might be something to ask more specific questions on an individual basis. Now, what if your spouse's IRA owned a piece of real estate already, 100% in the account, and they wanted to sell your IRA portion? That would be prohibited because your spouse's IRA and your IRA, again, are in a buyer-seller relationship. But had they, at the beginning, before your spouse bought the property in their IRA account, if they had decided at the beginning, let's buy the property on a 50-50 basis or whatever percentage, and at the outset both your spouse's IRA and your IRA bought a percentage, then that would work. And that would be what we consider to be a partnering transaction. Just other things to consider with prohibited transactions. Brothers, sisters, other family members are not disqualified under the rules, but if you're dealing with them for less than fair market value, you could have an issue there of, are you benefiting in any way from that? And again, you personally are not supposed to benefit from the investment in your IRA. Your IRA is certainly allowed to receive rental proceeds, profits on a sale, but you personally are not supposed to benefit on that transaction that your IRA is engaged in. So if you're lending money to a brother or sister on less than fair market value and you're feeling good about yourself because you made the investment, or in return they're maybe doing some babysitting for you or something like that, you're benefiting, that's the arrangement, it could be looked at as a prohibited transaction. You cannot put somebody in between yourself and a disqualified person to make it legal. So if you cannot lend money to your son from your IRA account, it's prohibited for your IRA to lend money to a third party and have that third party in turn lend money to your son. The IRS, when they look at a situation like that, what they're looking for is what is the intent of the parties involved. And if your intent is to circumvent the rules, it's going to be considered a step transaction and therefore prohibited. You cannot use your IRA asset for your own benefit or enjoyment. So if you're buying real estate, this is why I kind of mentioned a little while ago, it's got to be for investment purposes only. If you're buying a piece of real estate so that you can live in it, that you can use it as a vacation rental, anything like that, the IRS would again consider that to be a prohibited transaction. So when our clients are purchasing real estate in their IRA, it is because they're holding it for appreciation. They're holding it a long-term rental. They may be flipping the property, but they are not personally using that particular asset. Lastly, also providing sweat equity for your IRA asset, especially in the context of real estate. If you're investing in a property, your IRA should pay third parties to perform maintenance, work, etc. on behalf of your IRA account. You should not be doing the work. You shouldn't be painting the walls, putting in new carpet, anything like that. That should be paid by your IRA to a third party. Now we'll go through a couple of case studies to illustrate a little bit about the relationship more of Advanta as a record keeper and the client, and also just to talk about some more issues as well in regards to owning real estate. Our first case study, very straightforward, individual just buying a piece of raw land, maybe not something that's going to require a lot of maintenance, not something that's going to require the client to find a tenant, do anything like that, maybe just a very simple piece of property. The important thing when you're making an offer, if you're looking at buying property in your IRA, is to have that contract written where the buyer's name is indeed the IRA name. So the name, for instance, is Advanta IRA Services, LLC, for benefit of John Smith IRA, and then his account number. That's the name that will be on the contract, and ultimately that's the name that's going to appear on the deed to demonstrate to the IRS that your IRA, this is an investment held within the IRA. Your IRA owns that particular property. So when money left your IRA account to purchase the property, it was not taxable to you because the IRA actually made it as an investment. Your client would complete a form for us called a purchase authorization form. Essentially, you're telling us I'm buying this particular piece of raw land. Give us the information on who's handling the closing. So the client on that purchase authorization form lets us know that ABC Title is handling the closing. We will work directly with them to make sure the wording that appears on the contract, that wording that's here on this slide, appears on all of the closing documents. And then once we've ensured that the closing documents are prepared and titled correctly, we ultimately will send it to the client, in this case Mr. Smith, to make sure that he reads and approves the closing documents. We will not send money for a closing. We will not sign any documents unless the client has expressly written on the document that they have reviewed and approved it. So we will look at a HUD statement not for the numbers necessarily on the HUD and make sure they're correct. We're looking to make sure that the buyer's name is properly reflected. Ultimately, we will then sign the documents and wire the funds to closing once the client has approved of that transaction. And when the client sells the property at a later date, the important thing isn't necessarily the amount coming back, although certainly that's probably important to the client. From our standpoint, the key thing is just simply that any profits that are realized are going to come back into the IRA. The gains, again, are not going to be taxable. In this case, if they did sell this property in under a year's time, that is short-term capital gains. subject to income tax now, as opposed to having all those gains go into the IRA and continuing to defer them until they reach retirement age. Now, before I move on to the next case study, I did have a question come up in the chat box, and I would encourage anyone else, if you have questions as we go along, please type them in. Someone is over the age of 72, over the age of 70. They work. They do earn about $3,000 to $4,000 per year, other besides Social Security. How much can you contribute to the Roth IRA? I don't know the exact amount that you'd be able to contribute, but your Roth IRA, the contributions can only be based on the amount of that earned income. So you probably would be limited to somewhere between that $3,000 and $4,000 is how much you can contribute into your Roth IRA. The good thing is if you do work and you are earning that amount, you can then make the contributions. Now, one thing, the Roth IRA is different from a traditional. With a traditional IRA, you are not allowed to make contributions after age 70 and a half. With a Roth IRA, because it's a tax-free account, you can continue contributing past age 70 and a half so long as you have earned income. So to answer your question, you're going to be able to contribute probably around $3,000 to $4,000. As far as the exact dollar amount, you would want to talk to your CPA about that. There might be some deductions, things like that, that limit just exactly how much you can contribute. But because you have earned income, you will be able to contribute some to the Roth IRA. Next question came up. Maybe I'll leave this one for a little bit later about the checkbook control. Can you address the checkbook control scenario where the IRA lends funds to an LLC solely owned by the IRA owner? I think there's a little bit of confusion there. I'm going to talk about checkbook control at the end. I'll revisit this question and just how a little bit the understanding of a checkbook control is a little bit different than what's written in that question. Next case study, the simple wholesaling deal, an individual getting properties under assignment and then getting a property under contract and then simply assigning that contract to an end buyer and having that gain come back in their account. In this case, we have Olivia's got a Roth IRA, maybe not a whole lot of money in it. She's just getting started, only putting her $5,500 or so a year, but she's able to get a property under contract. She goes out, finds a property, can get it under contract at a good deal. So she has her IRA enter into the contract as the buyer. She makes sure that that contract is indeed assignable. And then he also has her Roth IRA issue the deposit for that particular investment. So $1,000 actually leaves her IRA as the escrow deposit for the property. She then finds a buyer that's willing to buy that house for more than she's got it under contract for, which allows her Roth IRA to then assign the contract for an assignment fee, having all of that gain come back into the Roth IRA account. Not something we see done all the time, but I have seen a few clients do this from time to time in their IRA, maybe do a couple of these deals a year just to get their Roth IRA growing at a healthy clip. But the next scenario, the next case study, though, is probably more where we see, I wouldn't say a bread and butter necessarily investment that we have here at Advanta, but probably one of the more common things that we would see is simply someone buying a piece of real estate for investment. Now, what's a little bit different, a little bit on this particular transaction, is this is a scenario we're going to see a partnering and kind of illustrate the difference here of how it's okay for two individuals to use their IRA as partners on a particular real estate deal. So Paul and Linda are husband and wife, and they each have some money in a traditional IRA account. But the property is kind of where they're looking, what their bread and butter is for investments, is a little bit more than either one of them has in their particular IRA. And there's also on top of that, they like to buy properties that need some rehab and ultimately think they make better gains in that function. So since they don't have enough money in their IRAs, they decide instead that they could partner on the transaction, have each IRA own a percentage of the overall purchase price, and they'll share expenses and income then accordingly. So again, the relationship of what Paul and Linda are doing within the account, they're each opening up and funding their own accounts. They're making the offer to purchase with both IRAs listed as an owner. And then again, they are going to review and approve all the documents for us. So rather than dealing with just one client, we are going to talk to both Paul and Linda, make sure that Paul and Linda both understand the transaction, make sure they both have approved before ultimately we will close the property, wire the funds, and get the deed back. Now, how do you title something like that? Now here's kind of the slide addressing that. If you're going to have two owners on there, it's important that both the full wording for each of their IRAs appears, as well as the percentage interest that each IRA is going to have in that property. Now the percentages, in this example, obviously to make it easy, it's 50-50. However, the percentages can be different. It could be 60-40, 30-70, however it works out. But the percentage is based on the amount that is contributed from each IRA. No more, no less. So if Paul's IRA contributed 70% towards the purchase price, his IRA must own exactly 70% of the property going forward. Now the other thing is, because they are related, Paul and Linda are related, that percentage is going to stay static throughout the entire terms of ownership. When they sell the property, they'll each split the proceeds from the sale. However, they could not, either one of them could not buy the other one out at some point down the line. So any any expenses related to the property, including taxes, insurance, maintenance, any repairs, will then be paid from each of the IRAs based on their percentage of ownership. So again, they're going to split, in this case, 50-50, but whatever the percentage may be, that's the way the expenses would have to be split. And then likewise, that it was the income comes back into their accounts. They're running this property out. It is going to be split between the two IRAs as well. Our job is to process the checks out so that Paul and Linda would send us the bills related to this property. We will get checks cut and mailed to their vendors. Also, any income that's coming back in, they can simply have their renters send their rent checks directly to us. We will deposit them into the account, and they'll be able to track their accounts online with online access, and our system will also send them daily updates anytime money is by email, anytime money is received on or money leaves their particular account. Now, if you were short on funds, this last example illustrates that first bullet point using a partnering technique. And again, it is permissible to partner with anyone, whether it's your spouse's IRA, your personal funds, other individuals. The key thing when you partner is that the income and expenses get split proportionally. And then again, the transaction must be from the outset. Now, last example, Paul and Linda were two buyers buying from one seller. If one IRA had closed on the property, they could not later then sell it to one of those other individuals. But again, it's important when you're partnering, that's much different from transacting. And again, it can be nuanced. If you have more questions on that, I would encourage you to give me a call, because there can be some scenarios where it gets a little interesting and you have to make sure you're following the rules correctly. Certainly you can make your annual contribution if you're short, if that's enough to get you quote-unquote over the hump. But you could also, I mentioned this earlier, you can have your IRA borrow funds. The caveat to that, again, is the IRS rules prohibit you from personally guaranteeing a loan on the property in which your IRA is an owner. So if you were going to get a loan, it has to be a non-recourse loan, meaning that the lender has no recourse against the owners of the property other than to foreclose. So the lender does have the ability still to foreclose. They just cannot sue the IRA or sue you personally for any discrepancy or anything that's left over after they foreclose. For that reason, most banks will not do non-recourse loans to investors. There are a couple of national lenders that do, so if you'd like their names and explore that in a little bit more detail, I'd be happy to, if you send me an email at the end of the presentation today, can send you the names and contact information for those institutions. Again, when you do a non-recourse loan, the loan is actually to the IRA. The IRA receives the rents, and then the IRA actually makes that loan payment each month. Our next case study is just private mortgage lending. An individual has money in their IRA. Not everybody wants to be a landlord. Not everybody wants to be a property owner. Some people do want to, can see the upside of real estate investment, but they just don't want to take on that responsibility of owning the property. So we do see a lot of clients, a number of individuals who decide to go the private mortgage route, where instead of being responsible for the property and finding tenants or getting contractors, they will simply lend money to somebody else and allow them to find those deals and then simply pay them back on a mortgage. In this case, we have Laura, who's working with Ray, who's rehabbing properties. So she can lend him money so he can find a property, fix it up, and then hopefully put some of the profits or some proceeds back into her IRA. Now again, it's important In the last couple of case studies, we're talking about property. Obviously, an individual, when they're looking to buy a property, they're doing their due diligence. They're looking at the property, deciding what's something they want to buy before making the offer. Again, when you're doing lending, it's important not only to do the due diligence on the property to know what your security is for the loan, but also doing your due diligence on the individual themselves. In this case, Laura does need to look at Ray, run a credit check if she deems that necessary, look at references, etc. Those decisions are all going to be up to Laura to make, but assuming she's satisfied, she does offer to lend him $80,000 of the $85,000 that's in her IRA account. Again, just to reiterate, we are not going to do the due diligence on Ray or the property. It is solely up to Laura to decide whether or not this is a loan or a deal that she wants to make. Now, when you lend money out of your IRA, just as if somebody asked you today, if somebody came up to you and said, "Can I borrow $20?" you get to decide what terms on which you're willing to lend. So if somebody asks you for $20, you're deciding already, is this some amount that I'm comfortable lending to this individual? When are they going to pay me back? When am I expecting to get my $20 back? Is there going to be any interest? Are they going to give me back $21 tomorrow or $25 in a few weeks? Well, in this case, Laura is running through some of the same things, obviously with just a much larger amount, and obviously maybe a little bit different terms involved. But essentially, her IRA is becoming a private bank. She can decide how much of her IRA she's willing to put out on a particular loan by looking at the borrower and the collateral, what the interest rate she's going to charge. How long does she want that money out? Is she okay with the $80,000 being tied up for a few years, or does she want that money back within 6 months? Is there any equity participation terms? Essentially, is she going to forego maybe a part of the interest rate to get a portion of Ray's profits? And is Ray obviously going to be willing to part with that? These are all kind of the factors that go into making the loan and allows Laura in this case to decide kind of how her IRA is going to grow. In this particular loan case, one of the case studies we drew this from, the client lent the money at 6%. So it's a pretty low interest rate for someone who's looking at doing rehab properties. But in return, Ray is giving up 25% of the profit. So she is getting a little bit of a joint venturing arrangement into that deal. She does get a monthly payment, low payment for Ray, obviously, of $400, and she gets a first mortgage on the property. So for Laura, if Ray does indeed walk away from the deal, she has the security of a first mortgage. Her IRA can foreclose and become the owner of the property. Maybe that's not an ideal scenario, but it does prevent her maybe from having or suffering a complete loss on that particular transaction. And the last case study we'll talk about today, and kind of again address the question that was brought up a little bit about the checkbook control entity. Now, checkbook control within the IRA community is typically achieved by an individual who sets up a brand new LLC and has their IRA own 100% of that new LLC membership. It can also be accomplished with a trust, a private trust, whereby an individual uses that trust as the legal entity or legal structure rather than using an LLC. But for the most part, we see it done with an LLC. Again, it's a brand new LLC, and the only member is the IRA itself. So it's not the IRA owner as the member. It is the IRA as its own entity becomes the owner of that LLC. It allows an individual, when they structure a transaction in this fashion, instead of having Advanta send a check or a wire to a closing and then ultimately pay all of the different expenses that pop up, instead the IRA client can have their funds in their account sent to an LLC bank account, whereby from there they are able to control the investments, purchase them, pay the bills, etc., all directly in and out of that LLC account. So it gives the client what they call checkbook control. They now are writing checks out of the LLC, which is essentially their IRA funds. Now the question that had popped up said, can you address a checkbook control scenario where the IRA lends funds to an LLC owned by the IRA owner? The way I read that is not really a true checkbook control scenario, because in that situation, the IRA is actually doing a promissory note or a loan to an LLC that is owned by the IRA owner personally. That would be a prohibited transaction. I think when we talk about checkbook control, the IRA is not lending money to an LLC. The IRA is actually contributing all of the capital and is becoming the sole member and sole owner within that LLC. Now, those types of entities do have some downsides and some things you need to be aware of. The coal industry started back in 1996 with the case of Swanson v. Commissioner, and it's been reaffirmed by the IRS in the latest tax court memo listed on this screen as well, that it is permissible for an IRA owner to be the manager of that LLC. At least that's what these tax court decisions and memos have stated, that it's not prohibited if you are the manager of that LLC. Now, you certainly, the latest case study here with Ellis, Mr. Ellis was also receiving compensation from the LLC. His IRA LLC was also paying him a salary. That was a prohibited transaction. All of the rules we talked about earlier as far as what you can invest in, who you can invest with, those same rules still apply to the checkbook control LLC. So even though you've kind of taken everything out of the IRA and put it into this neat little LLC that you've established, you still have to follow the same rules, and you need to keep good records for those particular investments. Now, there are companies out there that offer a checkbook control LLC where they establish the LLC for you, they establish the IRA, and they charge you, $4 or $5 grand in order to do that. If you're looking at using your IRA funds in this manner and getting checkbook control, I can tell you can use our services and those of a local attorney and pay far less. There's no secret formula they have. These are the same court cases that we're aware of that certainly those other providers are as well. Now, what are the advantages of using these trusts or these LLCs? Certainly there's a degree of anonymity. The name on the deed is not your IRA account. It is not your account number. It's just simply the name of the trust or the name of the LLC itself. If you're concerned solely with anonymity, we can leave your name or your account number off of any wording on when purchasing a piece of property. But for the most part, I think the reason individuals do it are the last three on this screen. Really the control aspect, being able to buy and sell investments and having control to write those checks as needed. So when an investment comes up, maybe at an auction, they can simply cut a check right there to buy that property. Or if they need to pay a contractor right there on the spot, they can write a check. Our company works very fast. If you do not have a checkbook control entity, we are probably issuing a check. If you give us an invoice, we're getting that check cut in 1 or 2 business days at the most, which is still very fast industry-wide, obviously not quite as fast as having that checkbook there in your hands. And another reason individuals use this is that they can hold more assets within their account and pay lower fees. We charge fees based sometimes on the number of assets in your account. And we consider the LLC as one asset. Even if the LLC owns 3 or 4 properties, we still consider the LLC as the singular asset within the account. Now the disadvantages, though, I kind of touched on a little bit already. Certainly you're not allowed to do the same prohibited investments for an IRA are prohibited again in an LLC, but since you now have that checkbook, it is easier for you to engage in a prohibited transaction. If you forgot the rules or if you weren't sure if it was prohibited or not, but you decided to do it anyway, that checkbook gives you the ability and the ease with which to make that transaction without putting it through us as the IRA administrator. And I think that's, again, the lack of oversight is a downside as well. If you make investments through your IRA directly, we have to see that transaction from start to finish. If we see any potential issues arise or if we see if something's definitely prohibited, we will let you know and possibly stop that investment. But even if you're doing everything right, you're not involved in prohibited transactions, you're dealing only with third parties, if you don't keep good records, I think that's another area where individuals can find themselves in a little bit of trouble with these types of entities. If the IRS were to ever audit your IRA, either the account with us or if they're auditing your LLC, you need to be able to provide them with proper records to show all the money in and all the money out of the IRA account. If the account is with us and we're doing all the record keeping, we can run a statement in a matter of moments that shows all of the funds in, all the funds out, and we will have all copies of the backup documentation, the rent checks, the invoices if needed. If you're doing a checkbook control entity and they audit your LLC, you're going to need to be able to show them the same types of documentation. So that's kind of one of the risks. Even if you are doing everything legally by the book, as far as what you can and can't invest in, if you don't have good records, you could face a problem if the IRS does indeed ever look into that type of entity. Now, as far as getting started, it's fairly simple, a matter of opening an account and funding it with either a transfer, a rollover, or maybe an annual contribution. and then ultimately telling us what investment that you look to make. A lot of our clients actually come to us already with the investment in mind, either the specific investment, maybe they're buying a private stock, or maybe they're investing in a particular piece of property. So they actually come to us and have us then work the process a little bit backwards with getting their account open and funded in order to make that investment. But again, a lot of others maybe know that they want to invest in real estate. They don't yet know the property, but it's a good idea at least to get your account open, get it funded with $1,000 or $2,000 so you have it for an escrow deposit so that you can make an offer on a particular property if it comes about. I would encourage anyone, if you have any questions after viewing this webinar, if you're someone who's watching it recorded line or the recorded version, please, you could jot down your questions as we've gone along. Email me, call me at any time with any questions that you have. Even if you're somebody who watched this today, something comes up, you weren't able to get the question typed in, or something else comes up later on, please call, please email me. I'd be more than happy to answer those questions. And also, visit our website, advantaira.com. Other upcoming seminars, other upcoming webinars are always listed on our site to show you, then we don't necessarily always talk just about real estate. Sometimes we discuss private lending, private placements, other things as well. Each presentation is a little bit different. A lot of it is the same. Some information is the same. But please do, all of our seminars, webinars are free, and you can see them all at advantaira.com. So at this time, I don't see any questions. I apologize again for the technical difficulties at the beginning, and I really appreciate those of you who did stay on and watch the whole presentation. Again, thank you for attending, and have a nice day.